Hello again, everyone, and happy holidays. It is Wednesday, December the 15th, 2021. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 top models, data, and charts that I think have the most significance in terms of where the U.S. stock market is headed through the end of this year and into 2022. So let's begin with market internals. We pay a lot of attention to market internals here at Asbury Research just because of the way the market has changed. I think the day-to-day trading in the market has been largely taken over by algorithmic trading. Computers trading with each other, that's where the vast majority of the volume comes from. And thus, rather than trying to chase the S&P when it's up 50 today and down 40 tomorrow, we're looking under the hood of the market and trying to determine what the condition is. And right now, the condition is starting to turn negative on a tactical basis. This is our Asbury 6. This is one of 2 tactical models that we have in-house. And this looks at 6 different metrics to try to determine the condition of the market. Only one of those metrics, the rate of change in the S&P 500, is based on the price of a stock or an index. Everything else we would call secondary indicators that can't be manipulated by daily trading back and forth. The relative performance between stocks and bonds, investor asset flows, corporate bond spreads, volume, breadth. Right now, 5 of 6 of these have turned red or negative, and you can see those dates on these. On 4 of them have just been within the past 2 days. The A6 gauges the daily technical health of the stock market. 4 or more metrics in one direction indicates the direction of the model, and right now the model is negative. So what does that mean? It doesn't mean that we sell all of our stock, but it does mean that we now start to pay more attention. We start to turn over rocks here to look for reasons to be moving some assets out of the market so we can protect our capital. So that brings us to number 2, know your levels. In a year like this, it was all about levels. It was the year of buy the dip. So here we have the S&P 500. And what I have here is from the beginning of the year, every successful test that we had of the 50-day moving average. Sometimes it was broken by a day, day and a half, but outside of this little piece here that we had between mid-September and mid-October, that also really didn't go anywhere. We've tested this 9 times, counting the most recent test at the beginning of December. Well, we're sliding back into that area now. It's 45.92 based on the 50-day moving average, down to 45.46, which is the September 2nd benchmark high. And if you want to, you can add the December 3rd most recent low at 44.95. But I think this 45.92 to 45.46 is the level to watch. Unless we can break that level, not just for a day or 2, but I would say a couple of days where the S&P's trading range is all the way underneath that support, it's too soon to assume that we've started a correction. There's another tool that we need to watch too. We need to watch volatility. Corrections need fear to feed the decline. So what we have here now is a chart of the VIX that goes back to May. We've got the S&P 500 up top. This is a daily chart. And what this shows is each time the VIX got above 24, since May, and actually it goes back farther into the beginning of the year. I just did this so we could see all of the various details on the chart. We've gotten up above 24 for a day or 2. That's the bottom. And a lot of these are coinciding with the test of the 50-day moving average. And the market goes right back up again. The only exception to the rule there was between November 26th and D6. This is this last little dip that we had into the December 3rd low. We started looking at the VIX staying up above 24 and thought, maybe this is the correction now. But quickly, it came right back. And you can see for about the past week or so, we're back underneath 24. So basically the Asbury 6 is telling us to be careful. The market internals are getting weak. We're sitting right on support in the S&P 500, and we're waiting for some evidence of sustained fear to drive the market down underneath that support level. If that doesn't happen, we're staying long. The other thing that I think is really important right now is technology. This market this year has not had a lot of leadership. I think everybody knows market breadth has been horrible for most of the year. And there's been very little leadership. Recently, the leaders have been tech and semiconductors. Both of those are actually starting to roll off a little bit today in terms of relative performance. So let's look at technology via the QQQ, which is the ETF that tracks the NDX, or the NASDAQ 100, which is the large cap index. Down on the bottom here is the total net assets invested in the Qs going back to August. And you can see that these assets really stopped expanding on November the 19th. We peaked 3 days later on November the 22nd. And note how these assets are kind of banging around in between 212.2 billion up on the top side and 203.7 billion on the downside. So even though you can't really see it on the price chart, you can see this indecision here. The Qs see these levels, quote unquote, see them. So to me, if we're going to get some tech leadership back again, we need to get these assets back above 212.2 billion, which we were at on November 19th and Dec 8th. On the flip side of that, we're testing the low of that range at 203.7 billion. If we break down through there in these assets, that tells me people are starting to leave that tech space, and that's a problem, because without the leadership of tech in an already thin market with very little leadership, that's going to just put more downside pressure on the market. So finally, let's look at relative performance of tech versus the broad market. And let's see kind of where the hot spot is that would be affected by more money coming out of the Qs. So here's the Qs here up top. Again, they track the NASDAQ 100 or the NDX. We're sitting right on top of this support at 385.80 to 382.71, which is a 50-day moving average and the high from September the 1st. And look what's going on underneath here in the lower panel. This is the daily relative performance of the Qs versus SPY. The SPY is the spider that tracks the S&P 500, of course. We're starting to break trend here in terms of quarterly relative outperformance. If this continues to outperform on a 63-day basis, which is one business quarter, this is likely to pull the Qs down through this support. And then, of course, we're going to be going back and tracking those assets. If those assets fall down underneath the low of the recent range that we saw in the previous slide, that means trouble for the market. So the best time that I like to do these is when there's really something tactical going on, and we have that happening right now. You need to watch support in the S&P 500. You really need to watch the internals. If you're an Asbury Research subscriber, you need to really keep a close eye on the Asbury 6, and you need to watch tech like a hawk. If we lose any more assets from tech, we're in trouble, and that could be the first step to some kind of a correction that is well overdue by many different metrics. So there's your Daily 5. Thanks for watching. If you like our approach to markets, please visit us at www.asburyresearch.com, and you can sign up for our free bi-weekly newsletter there, or you can ask us for further information. Thanks to all, and have a wonderful holiday season.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.